Hey there, I'm Aaron Klein, co-founder and CEO of Riskalyze. Welcome to the July 2021 Fintech Report Card, brought to you by our friends at wealthmanagement.com. Summer is heating up, and so is M&A activity in wealth tech. Let's start off with some of the deals that have been burning up the newswire. JPMorgan Chase CEO Jamie Dimon famously said, "Asset management, my line is open." And apparently, ESG provider OpenInvest did not get a busy signal. They joined 55IP in the lineup of relatively small and early-stage fintech assets that JPM has snapped up in the hopes of making them a successful part of the nation's most successful bank. What's interesting is the divergent strategies behind these two deals. While 55IP appears to still be available to the advisor market, OpenInvest made news for informing its RIA clients that they were ending their service for outside advisors, effectively becoming proprietary technology only for JPMorgan's wealth management business. Not sure what they'll rename it to, but I'm betting against closed invest. One of the industry's biggest TAMP platforms, AssetMark, closed on their $145 million deal to acquire Voyant. I'll confess I hadn't heard of Voyant before they announced this deal, largely because the Austin, Texas firm has almost zero U.S. presence, but an impressive roster of clients in global markets. This deal was announced as AssetMark made a change in leadership, promoting longtime executive Natalie Wolfson as CEO. Will AssetMark leverage their strong advisor network and extensive enterprise partnerships to mount a serious financial planning challenge for the hearts and minds of advisors here in the U.S.? We shall see. Another industry player, Broadridge, has acquired AdvisorStream, one of the marketing automation companies focused on advisors. This is a space that has already seen a lot of consolidation, with 20/10 being acquired by FMG Suite. As a board member at Snappy Kraken, one of the leading companies in the space, I think it's going to be very interesting to see how marketing for advisors continues to explode in growth over the next few years. Now, acquisitions are a big way companies like to spend their money to drive business growth, but then there are the outflows that are not quite as productive. Let's start with Robinhood, who incurred a record-setting fine for a bunch of general lapses in their job of being a broker-dealer and assessing the general suitability of clients for options trading. Now, what happens when the Facebook-esque motto of "move fast and break things" collides with regulatory compliance in financial services? A whopping $70 million fine, that's what. I'm sure Robinhood's marketing team is hard at work figuring out how to polish this smudge off the brand, but I can tell you one thing. Renaming the app Prince John is just not going to cut it, guys. Not to be outdone, in utterly shocking news, Charles Schwab announced that they were taking a $200 million charge for fines and restitution orders that they are expecting to see handed down by the SEC in a probe of their Schwab Intelligent Portfolios business. Now, the self-directed investing service launched a couple years ago to great fanfare with zero advisory fees, but it only took a quick glance to see that the portfolios had pretty massive cash allocations, which can be a way to lower portfolio risk, but also serve to juice revenues at Schwab Bank. While indirect revenues are the backbone of many consumer-facing services, the SEC likes to call them conflicts of interest when they involve the Investment Advisors Act of 1990 and are not clearly disclosed. The good news for Schwab, $200 million represents a mere 6% of last year's earnings. It stings, but it doesn't dent Schwab's business. Here's betting that Intelligent Portfolios didn't translate into the Intelligent Legal Advice Award for whatever lawyers signed off on those original disclosures and advertising. And look, I get it. Compliance can be nuanced and difficult. Perhaps in this summer of M&A, one of these firms should look into acquiring our very own conflict guy. Just kidding. He's kept me out of a lot of jams, so I think we'll keep conflict guy on the Fintech Report Card crew at all costs. Investnet held their advisor summit and an investor day featuring Q&A with market analysts, and they revealed their technology roadmap centered on stronger integrations across the products they've acquired and rolling their exchanges that offer easy ways to transact for credit and annuity products more deeply into money guide workflows. Bill Krager has spent the last year making a lot of changes under the hood, and it's exciting to see one of the leading companies in our space making real progress to deliver on some of the ideas that have been in the articulation phase for a while. Big congrats to the Investnet team. And in keeping with the Investnet theme, One asset manager has their sights set on being the next Investnet. Intelliflo, the newly rebranded collection of fintech assets acquired by Invesco, snagged former Investnet executive Blake Kennedy as their chief product officer. It's going to be a great opportunity for Blake, but also a big challenge. I mean, imagine if you ordered a chair from IKEA and a third of the parts arrived from Wayfair and a third of them from Etsy and a third of them from World Market, with nuts and bolts coming from Amazon. It's not going to be the easiest task to put that chair together, but on the other hand, you can sit there and enjoy some Swedish meatballs when you're done. That tortured analogy was definitely not brought to you by IKEA, but we wish Blake and the Intelliflo team lots of luck as they tackle the hard work of weaving this platform together. That'll do it for your July Fintech Report Card in partnership with our friends at wealthmanagement.com. I'm Aaron Klein, and we'll see you next month.